Hey everybody, well thank you for being here. On behalf of Mintz, a global law firm focused on working with technology and life science companies, we are delighted to be a sponsor of this wonderful event and also to be helping moderate this very interesting panel. We're really very fortunate to have such highly esteemed VCs, both at the early stage and mid-stage investing, who can talk to us about what they see as the advantages of investing in Southern California companies and San Diego companies in particular. Maybe just briefly, you could each do a quick little introduction of yourself, your fund, and then we'll dive into the questions.
Great. Andy White with Keshif Ventures. We're an early stage firm focused on data science-centric startups in San Diego.
Hey there, Tyson McDowell, Managing Partner at Greatscale Ventures, entrepreneur from San Diego from 2000 with an exit, and then now we're boutique company creators for impact-oriented AI companies in town. We take them from zero to profitability.
I'm Brian Mesic with Ankona Capital. We invest in early growth stage B2B software companies, so typically 5 to 10 million in ARR. Headquarters in Newport Beach, but I'm local here in San Diego.
Adam Alfi, partner at ICONIQ Growth. We're a growth stage software company investor based in San Francisco, where I'm based as well, but with offices in Palo Alto, New York, London, and Singapore.
So this is going to be fun. We have somebody from Northern California that we can all kind of like poke at. This is going to be a good conversation.
Is that what they look like?
Okay, so each of you, your funds have made some significant investments in Southern California in general, and San Diego in particular. So just to kick it off, why? What are the advantages of investing in Southern California that you find this in an attractive area? And in particular, I want to compare it to Northern California opportunities and other regions of the US as well. Rather than have each of you sort of respond, I'm going to just sort of probably have like 2 for each question, otherwise it might get a little redundant. So I thought on this one, Andy and Brian would be good ones to maybe kick off this. Andy, go ahead.
Sure. Our primary reason is that we want to invest in the community that we live in. And as the technology changes much more rapidly, we have to be focused on the areas that humans are the best at. And I think one of those areas that is kind of undeniable is when we get together and collectively work on a problem. And so that's something that we're able to do because we are here working with the early stage companies. It's much more important to get to know the individuals and the personalities and help supplement that with the resources that they need. And we think we can have some of the greatest impact by doing that early, working with teams to get to the point where they're ready for that next round of funding, and we have the right story to tell the investors that are maybe outside of the region and looking for a little more mature opportunities.
For us, it's probably a little bit more selfish. I mean, it's home turf, and it's just so much better to be able to invest in founders that you've had a chance to get to know for decades, potentially. When I met my wife 20 plus years ago, she said we'd live in San Diego eventually. So I started making investments here in semiconductor companies 20 plus years ago. So just having this base of relationships in a really friendly, warm, smallish community. I'm investing in founders that I've typically known for years. So you're going to see one founder on stage. I've known him since he started the company. We just closed our most recent investment a month ago, and I've known the founder for a decade.
So actually, I'm going to let Adam jump in on this just because this is interesting because you both talked about proximity. And we hear about this a lot in the Bay Area, right? That one of the challenges of investing outside the Bay Area is that you guys have proximity to so many opportunities. So is that an issue for you?
I don't think it's an issue. We invest broadly all over the United States as well as in Europe. Great software companies are being built all over the US as well as in Europe, and we and other VCs will beat a path to their door wherever we find the best companies.
Okay, great. So I want to focus a little bit on sort of unique ways that you invest in companies, in particular how that relates to, again, this region of Southern California and San Diego. And I know, Tyson, you have a very unique investment approach, and I know, Andy, you do too, so I thought it would be a good question for the two of you to respond. So why don't you start off, Tyson?
Sure. San Diego's interesting. I feel like there's way more entrepreneurs and capability and potential leaders and potential teams that grow up here and then leave. So it's more of like well, wait a minute, why can't we just do something here? And as we heard earlier, once you get to true scale, capital will beat down a path to your door. So it's actually really easy to see what the target is, and it's roughly maybe even some EBITDA in there, or at least you've got some high margin, unit margin going, repeat sales, 3 years of proving customer satisfaction, not exponential growth per se, but consistent, reliable, measurable growth. Well, you can calculate what it takes to go from founding day to that, and we try to do it within 10 million invested. So we just felt like, why burn all this time with 6 or 7 angel rounds and some other stuff along the way, and storytelling and hope? Why not just package it all up and go from zero to late stage or just profitability in one shot?
2022 and 2023 were a very challenging time for investing. We don't typically lead, and so if you're following and there's not as much happening, then you don't have as much deal flow. So we decided that for 2024, we were going to focus on getting involved even earlier and working on helping individuals build their new concepts. And so right now we're getting ready to release a new incubator program that is AI first, to help foster the opportunity for San Diego to be the home of the world's first billion-dollar company created by a single employee. And
That
I know
is so cool.
That's taking the advantages that we have with all of the different industries here, whether it's biotech, life science, or semiconductors, and then, of course, a smattering of big tech and other technologies. We do think that we have a unique formula here that would allow us to utilize our cross-border resources in a way that has not been done in the past, and to really start looking at what does the future look like, what are the areas that we will no longer need to focus on that will be done for us, and then what are those next generation of opportunities. If you're here for the keynote presentation, I think it was pretty ironic to have one slide showing that OpenAI went from 0 to 1 million users within days, but then the one thing that it's being used for most often is sales and marketing materials. Well, how many sales and marketing materials did OpenAI create in order to get from 1 million users in 5 days? Not very many. And so what does that future look like? What are those opportunities in that network effect? And how can we help focus on the elements that humans will continue to be the best at, that we need to be a part of? And then where are those processes going to be automated and allow us to take advantage of those network effects?
So both of you talked about creating a company effectively from scratch, right? Is that an opportunity here in San Diego in particular compared to like the Bay Area, or is that something that's kind of probably available everywhere? Or is that unique to our area?
Well, you're looking at me, so I don't think the idea of creating a company is unique. The idea that's unique is getting a company to actually exist enough that anyone's heard about it. So there's lots of company creation that goes on. San Diego, I think, has a lot of human resources, intellectual resources. It actually has a lot of wealth. It's just unstructured and it's not as institutionalized. So it feels like if you want to make the world's greatest stew, like San Diego's got all the ingredients like all over it in abundance. I do a lot in upstate New York's ecosystem, in Sacramento, more recently in Georgia. These secondary markets are lacking both in the capital and the sea of stuff you need to add things together. San Diego's so abundant in that area that people leave and we don't notice. So I think that we're unique in that way. It's not the company creation, it's just like this, there's just a lot of great stuff here.
Great. Okay, so very often we hear people kind of complain about the lack of mid to late stage funding in San Diego and how that sometimes hampers our companies. So Brian and Adam, one, is that true? And if it is true, how do we solve that? And if it's not true, tell us why it's not true.
I don't think it's really true. I mean, I think what local entrepreneurs need is what Andy and Tyson are doing, really helping some of the local founders get off the ground. That really is a local thing where I think there's a big advantage to doing that. I mean, we've got ICONIQ here. They're coming down, picking off the best of the best So the money's out there. It is extraordinarily hard to get a new fund off the ground, and I think maybe to some degree it is a disadvantage for founders that might not be as networked and connected in, but the capital is out there, it's everywhere. If you work hard and hustle, and you might have to hustle a little bit harder in San Diego than some other markets, but it's there.
I'd echo Brian. I'd say it's plausible that there's some latency in Bay Area VCs identifying the best opportunities in other parts of the country or other parts of the world. I know that, looking back 10 years, there was some latency even in identifying the best companies in New York. Yeah. And maybe some of those companies, deals were done at lower multiples for equivalent quality companies in the Bay Area. But by and large, these days, if it's a top quality software company or tech company, there's a lot of capital that's waiting to be deployed that people are eager to deploy, and VCs will beat a path to your door.
It's an efficient market. Maybe a little bit marginally more friction here, but it's an efficient market.
Okay. So just to follow with both of you, is there a particular area that you're excited about right now to invest, again, particularly looking for in San Diego and Southern California?
So we just do general B2B software. I sort of call it blue-collar software, easy to understand vertical apps and things like that. Everything that we invest in has an AI component, so we don't invest in AI specifically, but we invest, what we've always looked for, even before it was in vogue, was capital efficiency. We're not a venture investor, we're more growth equity, so we're not banking on unicorn home runs. We're really looking for things that we can get to scale and get to an exit and make a reasonable multiple. So capital efficient, strong, but not venture scale growers.
Adam?
Yeah, our kind of batting box from an investing standpoint is focusing on category leaders, whether it's a horizontal SaaS company, a vertical SaaS. I'd say maybe 80% of our portfolio is enterprise SaaS, B2B, but it's just focusing on kind of top performing companies when you look at their metrics and performance.
One interesting thing to note, we are looking for different things.
Yeah.
So part of what founders need to understand is who are you pitching and qualifying your target investor list before you go out. We're going to look at very different things.
True.
Okay. So, there's the 3 rules of real estate, right? Location, location, location. And I've always been told that the 3 rules of venture investing is management, management, management. Again, one of the things we sometimes hear is that there's not a lot of experienced founders in Southern California and San Diego compared to, again, the Bay Area. So maybe Andy and Tyson, quickly, you can address, again, has that been your experience? Is that something that is potentially holding us back compared to, again, other regions in the U.S.?
I think with the rapid shift in the change in the technology, that not being an experienced founder might be one of your greatest assets going into the next phase of change. I'm really glad that I don't work in an organization that has an LPA built around a dead concept of SaaS software development. We don't know what that next generation is going to look like. We're starting to get some glimmers of it, but I don't think it's going to be built around a monthly fee that you pay for a service that you only use part of, or multiple monthly fees that you pay for services that have redundant availability that you don't use. And so that experience can sometimes hold us back. We tend to focus on using the new technology to solve the old problem in a new way, when really we need to be starting to solve the new problems and focusing on what is going to be and what's no longer going to be necessary. And so I like the fact that you have some founders that are inexperienced and looking at this in a different way and coming at it from a different perspective. And then you have an opportunity to combine that with those who have experience in the areas that maybe that founder is lacking. And then now we might have an opportunity to combine that with some new technologies that can help adapt or augment that founder in areas that they don't have that experience.
Tyson, any thoughts on that?
Yeah, I agree with that entirely for emerging markets or emerging solution types. I think there's a lot more to the ecosystem than that. But if I were to diagnose the San Diego real estate problem, it's more like we lack a later stage mentorship culture. I think that we have also kind of an early stage culture where we're preparing our companies and our investees for someone else's region's interests. The strength here is grit. It's innovation. It's positive culture. Work experience is really high. This is a great place to be. We got the location. We call it the sunshine tax. It's the sunshine opportunity. I think that going towards companies that have a little more capital efficiency or they're more patient to discover their innovation, but if they can get more mentored by folks who understand the underlying, it's not the narrative of why people invest in the hype, it's the underlying bit about how someone unpacks a spreadsheet and tears apart your valuation, and prepare a founder and the investors to be ready to meet that market where it is, so that they're not, they actually accept lower valuations because they understand what they're arbitraging and they understand where they are in growing the pie. So I just feel like the mentorship has really fallen flat here in the last 20 years. I've been a part of that problem and a part of the solution in lots of cases. I think we just own our stuff. Like this is a great place to be. The people will be here, great people to work, so let's just execute.
Can I pick up, I know it's not my turn, can I pick up on one thing that Andy said?
Go ahead.
So one thing that's really interesting that we're seeing is we used to invest in insurgent companies that were going after either greenfield space or old legacy vendors, and a lot of what we're seeing now is actually software companies that are going after what used to be the insurgents who have become big and stale. So I think it really is interesting to see what might come to displace even some relatively more modern recent SaaS companies that can't either have tech debt or just can't keep up with changes.
So Andy and Tyson, one thing both of you sort of echoed, which I think is funny given this conversation we had earlier with the keynote speakers about AI. So are you suggesting that we should go ahead and train AI to basically have all the attributes of an experienced founder and let it train our founders?
AI is not going to pick that up. AI is trained on historical data, and our mentorship is trained on historical data. So no, AI is not going to solve the founder problem. I think that there's a lot of capital efficiency that's solved through the logical use of AI, and there's a ridiculous amount of execution risk associated with founders and early stage teams, like buying certain hype AI. Okay, yeah, the trend of the AI is absolutely real. A whole bunch of people are buying smoke oil, and they don't even know it. The people that are making it don't even know it's. I'm an AI engineer, so I can do that. I can say that. Proper use for capital efficiency reasons, yes. And don't let it screw up your customer relationship. It's great at customer relationships when supervised by people that understand how to operate great customer relationships at scale. Anyone else, you're going to just fall on your face. So I guess the short answer is no. Sorry.
It was really great at creating a Valentine's Day gift for my wife, by the way.
Well, that's a great, absolutely. Well, you need help with your wife.
So let's switch a little bit to valuations. In the post-COVID era, valuations went sky high, and a lot of VCs chased those valuations. I think most of us here would say that we knew that was not going to work out so well, and it didn't. And there's definitely some dead bodies along that highway. Have the valuations adjusted now? Given, 2023 was a relatively slow year, even not only compared to 2020, 21, and 22, but even just in general. Did valuations adjust because of that? Maybe Brian and Adam, you guys could address that.
So we did nothing in 2023 just because most companies weren't fundraising, good companies. They were focused on insider bridge rounds because they understood that everything had changed. The opportunities we saw were either not fundable at any valuation or were sort of test the waters raises to see if they could get a 21 valuation. What we're seeing today is sort of two different worlds. We're seeing a set of companies that have grown into their previous valuation, and we're leading rounds that are flat to moderately up from 2 to 3 years ago. And we're seeing other opportunities that just haven't. And the reality is that the world has changed. We're still seeing some nutty valuations from our point of view, not like we saw in 2021. But a down round isn't the end of the world. This public market equity values change, private market equity values change, and if you're building a startup that is focused on staying capital efficient and you can justify more capital, you take the down round. But valuations are down. We're in a world, SaaS companies have historically traded 6, 7, 8x revenue for a good company, maybe 10x on the upside. That's historic norms, and that's sort of where we are. And as a founder, as an investor, you ought to expect that you're going to exit for something in that range.
Yeah, lines up with what we're seeing. Valuations are not quite as insane as 2021, but still very healthy and priced to perfection in many cases.
Do you think that's because there's still a lot of money right out there available in the VC world? Is that what's driving valuations staying higher than we might have expected, given certainly the economics of 2023? And then maybe just as a quick transition, maybe talk a little bit about what you're seeing in 2024, the changes. Brian mentioned they didn't make any investments, and a lot of funds, by the way, did not make investments in new companies in 2023. But we're definitely seeing that change now in 2024. So maybe you guys can address that.
To be clear, we didn't make investments last year, but not because we didn't want to, but because we couldn't find anything to do. So the dam, I think, is breaking. And I think actually what we saw in Q1 was there was so much pent-up demand from capital that hadn't, I think most firms were like ours, they just couldn't invest last year. So a lot of pent-up demand to invest.
Yeah, a lot of our investments have been follow-ons in some of our best companies that we know really well and businesses we feel really good about. So we're still seeing exciting opportunities out there. There's obviously all this euphoria about generative AI. Still exceptionally early there. We've made a few investments, but if you look at the investable universe that is investment grade for a growth stage investor like ICONIQ, it's a very small number of companies today.
I mean, the numbers are outstanding. There's something like $1.5 trillion of capital sitting in private equity funds focused on software buyout. I mean, there's an enormous amount of money and relatively few quality opportunities.
So I think we're coming up at our 35-minute time limit, but maybe just real quick, AI. What opportunities do you see in particular? We've been talking about AI, obviously. And in particular, do you see any advantages, any companies that are interested to you within this region? And maybe all four of you can quickly address that. Andy, why don't we start with you and just move down?
Yeah, I think one of the biggest points on that is, again, in the keynote, there's a chart that was kind of burned down on the opportunities in different industries. If you look at that entire right side of that chart where there was only a $40 to $100 billion opportunity, those are opportunities that the big tech companies can't even look at now. I've got a $3 trillion company. To go after a $10 billion market is not even meaningful. And so I think we have a tremendous amount of opportunity for the entire stack to have individuals that are maybe now companies addressing very specific parts of the problem, working together to create those solutions using a combination of AI and other technologies so that we can address those with a much larger group of companies doing that and let big tech continue to focus on the foundation that just becomes the infrastructure that we're using to then solve all of these different aspects of needs from around the world.
Yeah, I agree with that. Leaning into the strength of San Diego, vertical AI solutions that are trained by teams that are excellent in the domain of the AI they're building is key, in my opinion. Those are the ones that aren't going to be the smoke oil solutions over this next 4 years of high efficiency adoption that you saw there. The infrastructure is going to be covered by the big boys, and someone might invent one here or there that's unique, but I think that we could do a lot of damage with practical application.
Yeah, the only thing I'll add is, every portfolio company is implementing AI throughout the product, but what we're looking at in terms of how it's going to affect our investment activities, we do think on the development side that 50% increase in the productivity of coding is real, and that's sort of another step function from cloud, et cetera. But what we're really looking for is how is AI going to impact the OpEx of a SaaS company? How is it going to change the fundamental economics of building a software company, whether it's recurring monthly revenue or something else? And we're still early there, but we're starting to see some really interesting signs that we can take a big chunk out of customer support costs. Number one, we haven't seen as much yet in marketing and sales, but it's coming. So I think it's going to really change not only the products that we're building, but the economics of running a software company.
Real quickly, I think it's going to change the economics for a lot of professional services firms too.
Yes.
I don't know if I'm best qualified to speak on this in terms of the latest wave of generative AI companies founded in the last couple of years that are based in San Diego. We haven't made any investments yet in that category.
We have.
Okay, so I guess we actually do have a little more time. Okay, I thought we were limited to 35 minutes. I guess we have a little more time than I thought. Great, let's keep talking. So let's talk a little bit about founding teams. I'd love to hear a little bit. Maybe each of you can respond to this. How do you build the team, right? So many times when entrepreneurs come to me, there's a sole entrepreneur. They've got a great idea. I'm working with them to form their company, help them put the pitch together, but there's no team there yet, right? And so what you guys are great at typically is helping them build that team. So I'd love to hear a little bit about, what do you look for in that founder, well, first of all, to make sure that they're okay with that, and then what's the process you use to help them build the team? And maybe we could just go down we'll go down the whole line on this one. Andy?
Yeah, this is one that I think is changing rapidly. We used to talk about team and their cohesion and how they balanced each other. I'm very interested in incredibly small teams that continue to wear many hats. And I think that's where there has been a challenge in the past, is that you have to wear many hats in the beginning, but then you also needed that founding team that were focused on a certain area, and it caused friction within. So what does happen when you are able to augment those individuals with the technology and actually grow the company out of that? You get stronger culture, you are more uniform in your decision making, and you can stay focused on the primary task that's at hand. And so I'm excited to see how that evolves. Yes, we have some pattern matching based off of previous experience, and I'm trying not to let that cloud my vision for where we go from here.
Yeah, we look really specifically these days for not founder specifically, but founding teams and emerging at the right timing. So depending on the type of the company, you either need a more technically forward or you need a more sales forward or market specific. Who's the first person to show up? It's got to match the outcome opportunity. It's very unlikely that person's going to be the best person to run the growth stage company that these guys will invest in. And so we also look for humility and understanding that this is about wealth creation for every stakeholder, not valuation, not percentage of the pie. It's about where are you in the long-term waterfall that's likely for your product market fit, and then your growth capital fit and your exit fit. So we really look for humility. We look for someone that can understand business principles. They never come to the table with them in the venture space. We have to teach them. And some founders get really mad when we tell them that you're not the founder and you're not going to be exiting that, but you're going to still make hundreds of millions of dollars. And others that don't, they're like, hey, this is great, let's all do this together. That's our people.
I got to just jump in on that because Tyson, for those of you maybe who've been in San Diego a long time like I have, there was a wonderful presentation. John Moores said this on stage. Someone asked him, what's the number one thing you look for when you're looking at founders to invest in? He said, I have one simple question. Would you rather be rich or would you rather be CEO? And I love that because that's basically what you just said. I love it. Go ahead.
We don't do any team building. We're investing in teams that are fully formed, maybe with some spots, but I'll sort of spin that question a little bit. I'm old school and old, and I still have sort of a bias for teams that are together in one place. I haven't bought into the whole everything's going to be great with nobody coming into the office, especially for early career folks who lack the mentorship in a remote environment.
Adam?
From a pre-investment standpoint, like many of the folks here, I'm sure team is a massive focus for us, and a huge part of our diligence is determining, is this the team that has the best probability of winning the category? From a post-investment standpoint, there is a lot of focus on equipping our founders to augment and build out their teams over time. We tend to find that, going from 1 to 10 million ARR and 20 to 100 million ARR and 100 million to, and onward are gear shifts in the life of a company, and oftentimes require a different skill set, a different mode of operating, different maturity level of CFO or CRO, and so a lot of focus in terms of finding the best folks we know from across our ecosystem and helping calibrate the best talent at each gear shift in growth.
Can I add one thing to that? The only thing I'll say is there's a bunch of box checking things that people want to see, but ultimately, if you're a founder and you want to get an investment from a fund, ultimately the persuasion is all about the personal relationship you're able to build. So fine, check the boxes, but understand that it's theoretically sort of a rational decision, but at the end of the day, it is really an emotional connection. and a bond with an investor who's going to take you to committee and run through the whole process with you. It's a really personal relationship building thing that gets over the edge after the boxes are checked.
Okay, as we wrap up, I want each of you to address the founders out there and explain to them why they should be looking for funding from a Southern California-based fund as opposed to going to Northern California. And Adam, you can be the counterpoint. Go ahead, Ian.
Well, specifically for what we're doing is if you are either an investor or an entrepreneur interested in an AI-first, appless future, then you should come talk to us because we are going to do everything we can to help build that infrastructure in San Diego to make you successful.
I'd say it's because you're here, you got to do it here. Mutual trust and respect is required for anything to work, and the times are good and bad. So it was shared already, but it just comes right down to that. You have to rub elbows with the people that provide capital, and there has to be mutual trust development. It takes 9 to 24 months for that. Start now, keep going, and the money will come. Just start executing and be humble.
Yeah, on a practical level, it is just easier to build the kind of relationships that I described are necessary with somebody that you can have coffee with 18 months before you're asking for money. Don't meet an investor when you're asking for a check. We're not raising our next fund until 2026. I'm on the road once for a whole week every quarter at a minimum, meeting our next investors. So you have a tremendous advantage with local investors who are much more willing to spend time with you, building a relationship and extending their networks versus a fund that might not be here. And from a pragmatic level, I think we've made 6 investments in San Diego. We know a lot of people in San Diego. So from a team building perspective, from the perspective of, oh God, everything's going wrong, can we have coffee, can I talk to you about this? It's just, it's nice, it's an advantage.
All right, counterpoint.
No counterpoint. I think there's nothing to take away from working with phenomenal investors like we have here in Southern California and in San Diego. I just say that over time, as great software companies are looking to grow and scale globally, there's value in having kind of the strongest networks in the technology world concentrated behind you, and so we tend to have a very great relationship and get a lot of calls from the best investors down here who want ICONIQ to be part of it and help fuel that journey and throw gasoline on that fire. So,
And I want to throw one thing in. When you guys get really freaking rich and your company's going great, you may need to move out of San Diego for these reasons. When you do, please bring the wealth back home.
Well, thank you very much. This was a really great panel. Thank you, everybody.